Welcome to the Deep Dive, the place where we take the world's most complex businesses and biggest stories and give you the distilled insight you need to know.
And today we are talking about a company that is truly a giant. It operates on a level of scale that very few companies ever achieve.
And yet, for all that scale, most people interact with their services every single day without even, registering the name. We're talking about Sodexo.
Exactly. One of the world's largest food services and facilities management companies. I mean, they provide everything from patient meals in a hospital to full-service catering at a global corporation.
Okay, so let's unpack this. Our sources today, and we've got deep dives into their operations, their Q3 2025 earnings call, and some critical external analysis, they all reveal this really striking duality. You have a company of staggering global scale, but at the same time, it's struggling. It's struggling intensely with these painful, very localized financial pressures.
And that's really the core mission of our deep dive today. Scale is supposed to bring stability, right? It's supposed to bring efficiency and, pricing power.
Right.
But what we're seeing here is a paradox. How does a global juggernaut like Sodexo maintain control across 45 countries while at the same time dealing with headwinds that are so severe they're forced to dramatically revise their forecasts downward?
We really have to start by just appreciating how vast this thing is. I mean, the sheer footprint is almost incomprehensible.
It is.
You're talking about 430,000 employees. That is effectively the population of a major European city, all working for one company.
And they're in 45 countries, serving 33,000 client organizations. The number that really gets me is touching the lives of 80 million consumers.
Daily.
Daily.
Yeah.
And that daily service happens in just the most varied, high-stakes environments you can imagine.
Oh, absolutely. I mean, you could find Sodexo running the mess hall at a really remote mining operation 1 minute.
And then the next, they're managing patient catering in a U.S. hospital, or providing concierge service at a corporate headquarters, or even serving a fine dining experience at the top of the Eiffel Tower.
The second you realize that one single global system has to standardize food safety and quality across all of those wildly different environments, the complexity just becomes staggering.
It really does. How do you ensure consistency when you're dealing with different regulations, different labor laws, different consumer expectations, continent to continent?
You can't. Not with people alone.
Exactly. And that's why we have to start with the systems. Managing this level of operational complexity, it requires more than just dedicated personnel. It demands a unified, sophisticated digital control grid. You can't possibly audit every location every week.
So you have to rely on technology to bridge that gap.
You do. Okay, let's unpack this, starting with how they even try to ensure that consistency across the globe.
The fundamental challenge, and the sources really detail this, is visibility and rapid change. If you are running an organization with 33,000 client organizations, most of which are multi-site operations themselves, you just can't visit every single location regularly. It's physically impossible.
And even if a site is perfect today, the equipment, the staff, the menu, that could all change tomorrow. So the necessity here is really codified in their strategy. They say you must rely on good structure, good resources, and good systems to maintain that excellence.
So Sodexo's solution for this monumental task, is leveraging these advanced digital platforms. Specifically, we're talking about safety culture to gain that real-time global visibility.
And the most crucial application for this tech, and this is where failure is completely unacceptable, is in food safety.
Of course.
They've shifted their entire hazard analysis critical control point program, that's HACCP, into a digital format. And for anyone who's not familiar, HACCP is it's really the global benchmark for identifying and controlling food safety hazards from farm to fork.
So the intent is to be proactive, predictive.
Exactly. They're not waiting for an incident report to come in. They're trying to catch potential failures before they even happen.
Which is a huge shift from the old way of doing things. I mean, transforming HACCP from a dusty clipboard log.
Yeah, a log that was probably filled out days after the fact and then just stored away in a file cabinet somewhere.
Right, into an active, trackable, and immediate digital system. That's transformative for their risk profile.
It is. And the sources walk us through the granular detail of this workflow, and it really shows the level of control they now have.
So how does the unit operator on the ground actually, do this? How do they execute this digital compliance?
Well, it's designed to be quick and mandatory. To start an inspection, the operator just uses their camera to scan a QR code that's specific to that piece of equipment or that location.
Okay, so it's a QR code right on the piece of equipment.
Exactly, right on the equipment.
Yeah.
And that action instantly confirms the site name, the equipment, and the date. It basically timestamps the compliance moment.
Then the real data collection starts.
Right. They record critical metrics like the internal temperature of a key chiller unit, and they have to add any necessary contextual notes.
And crucially, they have to take a picture.
A geotagged picture, yes, of the equipment and thermometer reading. It's objective proof. Finally, the operator signs off, and that completed inspection is immediately locked into the central system.
And that locking mechanism is key, I assume.
It is. It ensures accountability. It prevents any backdating or, falsifying records. But the visibility payoff, that's where the system truly justifies its investment.
Because in the old paper-based world, that feedback might take months to filter up from the field to a regional manager.
Months. And a failure might have been repeated dozens of times before central management even realized there was a systemic problem.
But now, that district manager doesn't have to physically travel hundreds of miles.
No, they can just pull up a dashboard and view a real-time compliance feed for every single site under their purview. They can see trends immediately.
Like which location is consistently missing its temperature check window. Or maybe which staff members are failing to complete the checklist fully.
Exactly. It fundamentally shifts management from, responsive damage control to predictive monitoring.
So if a dozen sites in one district suddenly start showing weird readings in their freezer temperature logs.
That's not just a localized failure anymore. That's a signal. It's a signal that there might be a batch of faulty equipment or maybe a widespread training gap that needs immediate attention.
But the platform is used for so much more than just temperature logs and compliance, right? This technology and all the data it generates is critical for achieving broader operational excellence, for maintaining the Sodexo brand.
Precisely. They're using these digital tools for what they call brand deployment. They're auditing the culinary offer and the whole guest experience, the entire front of house standpoint.
So it's not just checking if the food is safe to eat. It's also checking if the food is appealing, if it's marketed correctly.
Absolutely. Think about the need for standardization across 45 countries. They are using the platform to ensure that all the customer-facing elements are consistent.
So like auditing that the signage is complete, that it's legible, it have the right pricing, the right allergen information.
All of that. And clear descriptors for the meals. They're also auditing the visual appeal of the food that's on display. They want that standardized, visually pleasing experience, whether you're in a corporate cafeteria in London or a university dining hall in New York.
The efficiency angle here also, it has to translate directly into improving the lives of the unit operators, which management said was a goal.
It does. They're automating all these manual processes, getting rid of file cabinets full of paper logs, ditching physical sign-in sheets. This frees up the operator to actually focus on service, not on paperwork.
And this efficiency moves pretty quickly past just internal compliance and into protecting their high-stakes financial assets.
It does. We found a really specific, very compelling example of this. The deployment of sensors on high-value equipment like refrigerators, freezers, and coolers.
And the reason for this is purely financial.
Starkly financial, yes. The sources are very specific on this point.
So what is the cost of failure if one of these major cold storage units just goes down unexpectedly?
Each time a cooler or a freezer goes down, it represents a loss of about $25,000 worth of inventory at that one specific site.
$25,000. That's a staggering number for a single localized failure.
It is.
Hold on. Is that $25,000 just the cost of the ingredients and the food? Or is there more to it? I mean, is the source maybe overstating the benefit here just to justify the investment in the sensors?
That's a fair question. That number likely includes the cost of the inventory itself, but in the context of a massive operation like Sodexo, it definitely carries additional costs.
Right.
You have to factor in the labor to identify, remove, and dispose of all the spoiled food. Then there are the rush order costs to replace that inventory. And potentially the regulatory risk and brand damage if that failure leads to a service disruption.
So when you add all that up,
When you add it all up, while $25,000 is a high figure, it serves to highlight that this kind of automation isn't a luxury. It's a necessary hedge against monumentally costly operational failure. By automating the temperature monitoring and alerting, they prevent this costly loss before it can even happen.
that's a crucial point. When you multiply $25,000 in lost inventory across 33,000 client organizations, The total potential annual savings from automation alone, it has to be in the millions.
Easily, just from avoiding these preventable failures.
And this platform also contributes directly to continuous improvement, right? Through training and these immediate feedback loops.
That's right. The dashboard doesn't just display temperature logs, it also tracks compliance on training modules. So if the system notices that a specific district, or maybe even a single unit, has low completion rates on a certain required training.
Say, a new module on knife safety or allergen management.
Exactly. That low compliance trend becomes an automatic indicator.
So management doesn't have to wait for the quarterly review. They can see the gap immediately.
Immediately. It allows them to quickly administer tweaks, roll out targeted training, or make systemic changes to a new process they just launched. This instant feedback loop means the entire operational system is continuously improving. It's getting better, faster, and safer all the time.
So if we synthesize this first section, what this technology really does is it fundamentally shifts the company's internal culture. It moves the focus away from unit operators, just, checking the box, to fulfill a requirement.
To performing tasks with purpose, because they know the data they're generating is valuable and it's immediately actionable.
They're getting the support and the resources, the predictive analytics that they would never have had otherwise.
Precisely. The ultimate goal is to leverage this global control grid to drive small, positive, incremental changes that are really impactful.
Right.
Changes that are going to make them either more competitive, improve their commercial results, or just improve the working lives of those unit operators. This technology really underpins the entire promise of Sodexo's scale.
It gives them the comfort of knowing that despite the enormous scale, the underlying system is working. It's ensuring safety, it's protecting inventory.
Yeah.
But a robust operational system, as solid as it is, does not operate in a vacuum. It doesn't insulate the company against macro market forces.
No, it doesn't.
And that brings us squarely to the financial realities.
And this transition here is so crucial because it really highlights the limits of operational excellence.
Yeah.
You can have the most advanced technology control grid in the world. But if your clients are hesitant to sign new contracts, if they're being cautious with their budgets, and if your cost of labor and goods is rising faster than you can raise your prices, you're going to face profound margin pressure.
So we're dissecting the Q3 2025 earnings presentation. This took place on July 1st, 2025. And the global headline figures, they really reinforce the scale we just talked about. Group revenues for the quarter reached a massive 6.1 billion euros.
But the key metric for performance assessment is always organic growth. That's what strips out the noise of currency fluctuations and acquisitions.
And that came in at plus 3.0% for the quarter.
Which was generally in line with expectations. For the first 9 months of the fiscal year, organic growth was a little higher at plus 3.4%.
But that global average of 3.0% is misleading. It masks these wildly divergent geographic performances. And this is where we start to see the localized strains and pressures really start to emerge.
Yeah, let's break that down, starting with the regions that are performing strongly. We can start with the rest of the world segment. It delivered stellar organic growth of plus 7.5%.
Wow, 7.5%.
Yeah. And this success was driven by really robust and strong performances in key emerging geographies. Think India, Brazil, Australia. These are markets that are often characterized by less saturated competition and, faster economic development, which lets Sodexo scale up quickly.
And Australia is particularly highlighted as a success story in the source material.
It is. They successfully mobilized the massive Santos contract during the spring, and that was specifically cited as a clear example of strong execution. The client feedback they got on service quality, professionalism, and rapid execution under tough conditions was apparently excellent.
So that demonstrates that their engine for securing and executing new large-scale business outside of their traditional core markets is firing on all cylinders.
It is. Then you have Europe, their other large segment. It showed solid improvement compared to the previous quarter, posting organic growth of plus 3.3%.
Okay, still solid.
And this was heavily driven by the resilience and momentum they saw in the Esquerre and senior segments across the continent. So basically, they're successfully serving the aging population.
And their events division, Sodexo Live, which handles stadiums and venues.
That benefited significantly from robust tourism in France and strong volume in the UK airport lounges.
But even in Europe, there's a note of caution. The business and administration segment saw modest growth, but that was partially offset by softer volumes reflecting those broader macro headwinds.
That's right. Even in their strong markets, clients are showing some caution. And then we get to North America.
And this is the immediate and overwhelming focus of investor concern. It's the primary source of the company's financial tremors. North America's organic growth was just plus 1.2%.
1.2%. It's a dramatic deceleration compared to the 7.5% we just saw in the rest of the world.
Now, management confirms this performance did benefit from some healthy pricing and new business, but it was, and this is a quote, severely weighed down by the impact of contract losses from prior periods.
And those prior period contract losses, that's crucial context we can't just overlook. Sodexo is still absorbing the impact of a major global facility management contract that was lost last year.
Right.
And they're still feeling the hangover from past contract exits in the education sector. These losses really put a cap on how much their new business wins can contribute to the overall revenue growth.
And if we look internally at the operational dynamics, we see another area of weakness when you compare food services against facilities management, or FM.
Yeah, that's a good point. Year to date, food services organic growth is stronger, sitting around 4%, which is good.
But FM is significantly weaker, hovering around 2%.
And the sources explain this weakness in the facilities management segment is largely due to lower project work.
So these are the big one-off project components, things like major maintenance, system upgrades, energy efficiency retrofits.
Exactly. And clients are currently being very, very cautious with their discretionary budgets. They're holding back on non-essential capital spending and only committing to the core service maintenance.
And management noted they are not expecting a major recovery in that project work in Q4.
And that is the critical point. If management is already discounting a recovery in the near future, it raises a big strategic question. Is that lost project growth just delayed, or is it permanently gone?
As clients maybe seek out smaller, more nimble specialty contractors for that kind of work.
Right. Management's stance suggests a challenging environment where cautious clients mean lost growth may not be recovered soon, which forces them to become extremely lean.
Okay, finally, let's dive into the critical tension point that is threatening margins globally, but especially in North America, the gap between pricing and inflation.
This is key. Globally, the pricing impact that Sodexo is achieving across its portfolio is close to 3%.
And that 3% sounds respectable until you compare it to their cost structure, particularly in the U.S.
Right. The sources detail that when you look at the inflation indexes for the U.S. market, the food away from home inflation index, that's trending closer to 4%.
So in its largest and most crucial market, Sodexo's pricing, even after they implement increases, is not fully keeping pace with the rising cost of the goods and ingredients they're buying.
Exactly. That 1 percentage point difference, 3% pricing versus 4% inflation, that is pure margin compression.
And it raises the essential question of why.
Right.
Why can't their pricing fully keep pace? Is it competitive pressure? Is it contracts that lock them into lower prices?
Or is it just clients, like universities, pushing back really intensely on rising costs? Whatever the reason, they are running faster just to stay in the same place when it comes to covering their costs in these key segments.
The underlying dynamic here confirms that the global control grid, built on efficiency and tech, is great for managing your internal costs. But it can't stop those external market forces from just squeezing your margins. And that relentless squeeze concentrated in the U.S. is what dictates the revised financial outlook for the entire company.
And North America accounts for roughly half of Sodexo's global revenue. So when that colossal segment delivers organic growth of only 1.2% in a high inflation environment, it's not just a wobble.
No. It sends tremors across the entire organization, and it leads directly to revised expectations and a real sense of strategic urgency.
So let's focus on that North American segment's Q3 performance. While the overall number was low, there were still some bright spots that kept it from being worse.
Right. Sodexo Live's performing well, benefiting from higher passenger volumes in airline lounges.
And U.S. healthcare is solid, thanks to management successfully implementing pricing power and scope gains within their existing contracts.
But the education sector, specifically the collegiate segment, that's where the pain is really acute and, frankly, unsustainable. Management noted that the recent sales and retention season in universities was significantly below their expectations.
And why is this segment, which used to be just a bedrock of long-term revenue, suddenly crumbling? Management identified two primary intertwined factors.
The first one was aggressive market dynamics. So significant competitive pressure.
Right. Competitors like Aramark, or even smaller, specialized regional players, are becoming increasingly sophisticated and aggressive in bidding for these major university accounts.
And the second factor was internal to the clients themselves. High turnover within their organizations.
That's a huge one. When the long-standing university contact, the person who is the champion of the Sodexo relationship, suddenly leaves, that relationship is severely disrupted.
And it gives the new leadership an open invitation to put the contract out for a competitive bid.
It's the perfect storm. Higher competition meeting client instability. And this environment in the university segment forced them to make a very difficult decision to revise the company's future financial outlook.
And this is the most critical piece of news from that earnings presentation. It's the reason analysts are paying such close attention. The softer outlook for fiscal year 2026.
Sodexo revised its organic revenue growth forecast downward significantly.
The previous relatively healthy estimate was for growth between 3% and 4%.
And the revised forecast is now just 1.5% to 2.5%.
To cut your growth forecast by nearly half at the midpoint, that is a stark admission of the difficulties they are facing and the seriousness of this contract win momentum problem.
And furthermore, they signaled margin compression. The company expects its underlying operating profit margin to dip slightly below 2025 levels.
Which makes sense. The slowdown is driven not just by the slower growth, but by a reported 10.5% drop in revenue from new signings.
Right. When you are losing contracts faster than you are winning new ones, your growth trajectory immediately inverts.
So this means that organic growth is still going to rely heavily on price hikes. They confirm they have to continue to raise prices.
But those increases will be insufficient to fully offset the strong headwinds, especially in U.S. education and healthcare.
And the performance in those key U.S. sectors is also linked to some deeply rooted demographic realities.
It is. U.S. education and healthcare are underperforming partly due to these persistent lower enrollment rates, specifically noted in the Northeast and Midwest regions. Fewer students on campus means lower per capita dining revenue, regardless of how good the food is.
And that's a structural issue, not a cyclical one, which makes it particularly challenging for Sodexo to address quickly.
And this disappointment in the U.S. education retention results was specifically noted by management, which brings us to the kind of confusing calculation of the retention target.
Yeah, this is a complex but really important detail for shareholders to grasp. Retention rate is the ultimate measure of client satisfaction and competitive strength.
And management had to acknowledge the impact of recent education losses and also the ambiguity around the exact financial scope of that major global facility management contract loss they'd flagged earlier.
Can you just dissect the complexity of this updated retention target for us? Break down why that one single contract loss warps the calculation for the entire global company.
Sure. So the standard metric is retention, including all your losses. Their current expectation is to land slightly below 94% retention if you include the impact of that one massive FM contract loss.
Okay, so slightly below 94%.
But they also provided a second higher figure. If you strategically exclude that single large FM loss, they expect the retention rate to be above 94%.
So, by providing two numbers, they're essentially asking investors to ignore a massive, painful reality in favor of a slightly better operational trend.
It sounds cynical, but strategically, yes. They're trying to separate the systemic failure, the competitive losses in education, which are ongoing, from the one-off shock of losing a monumental global contract.
And the fact that one single loss warps the calculation so severely just underscores the colossal financial impact one contract can have on this multi-billion-euro giant.
It makes a company look more volatile than its size would suggest, and it confirms that the environment for securing and renewing these massive contracts is intensely competitive, unstable, and unforgiving.
Which means, to really understand what that competitive pressure looks like on the ground, we have to move beyond the numbers and look at a specific exit in detail.
Right. And when a company the size of Sodexo talks about competitive pressure and client turnover, it can all feel a bit abstract. The loss of the Tulane University contract after 40 years of service gives us a very concrete, real-world example of what happens when that pressure meets a client's heightened ambition.
40 years. That is an entire generation of students fed and serviced by a single provider. And Tulane announced on January 10th that this partnership was just ending.
And that Aramark Collegiate Hospitality would be replacing Sodexo starting in July. This wasn't a minor vendor switch, it was the end of an era.
So why did this seismic shift happen?
Tulane initiated a competitive bid process in early October after deciding not to renew the Sodexo contract. And the university's leadership explicitly stated they were seeking a partner that aligned with the university's heightened ambition for their campus dining program.
And that phrase, heightened ambition, that's not just PR speak.
No, not at all. It signals that the established service model, the default menu, the existing facilities, was fundamentally failing to meet the evolving expectations of students and faculty.
Who are now accustomed to a diverse, technologically smooth, and socially conscious dining experience.
Exactly. It implies that the incumbent Sodexo, despite its long history, failed to demonstrate a compelling vision for the path forward.
And Aramark's proposed enhancements, which are detailed in the sources, they illustrate precisely what the competition is offering to win these contracts now.
They promise not just continuity, but aggressive modernization and investment.
So let's detail those specific enhancements because they really define the competitive landscape in U.S. education now. Aramark proposed new station offerings in key areas like the dining room and the Green Wave Grill.
They also planned enhancements for numerous existing food destinations all across campus, the academic quad, the medical school cafeteria, the LBC food court. But critically, they're bringing in recognizable, fresh concepts that appeal to a younger, more demanding consumer base.
Like what?
For instance, new concepts coming online for August included Shake Smart, a new convenience store concept, and a new concept in Le Gourmet. These are specialized offerings designed to compete directly with off-campus, fast casual restaurants.
And the technology integration was a huge factor.
Huge. The new partnership will immediately adopt Grubhub for future online and to-go orders. This streamlines the digital experience for students and staff.
Integrating the campus meal plan seamlessly with the digital convenience they expect from every other service provider in their lives.
Right, and this suggests that Sodexo's internal digital tools, which we praised earlier, for efficiency and compliance.
They might not have translated effectively into a superior guest experience on campus.
That's a key distinction. The operational excellence grid ensures safety and efficiency, but the customer-facing tech, like Grubhub integration, that's what drives customer satisfaction.
And Aramark also leaned into sustainability and operational innovation.
Very aggressively. The dining team announced a major move to reduce single-use compostables on campus by rolling out a new reusable container program.
And that was implemented immediately in the LBC food court and retail locations.
Yes. So it demonstrates a commitment to ESG, environmental, social, and governance principles that universities now demand from their partners. The bid was about more than just the food. It was about values alignment.
What's fascinating, and often the most politically charged part of these transitions, is what happens to the hundreds of hourly employees who work for Sodexo.
This is a crucial detail for continuity of service and for protecting the university's image. Despite Sodexo's contract ending, all current Sodexo hourly employees were guaranteed a position with Aramark,
Which maintains institutional knowledge, minimizes disruption, and protects the existing workforce.
And Aramark significantly raised the bar on pay and benefits, which shows how competition is driving up labor costs in this sector.
What were the guarantees?
The financial guarantees were explicit. Those employees will receive their current rate of pay or better, with a guaranteed a minimum of $15 per hour. That is a significant factor in a service industry that's battling labor shortages.
And beyond the immediate pay increase, Aramark is also investing in the employees' long-term career paths.
They are. They're providing enhanced professional development, including more formal culinary and hospitality training programs in partnership with the New Orleans Culinary and Hospitality Institute. This isn't just a job, it's a career development pathway.
That's a massive investment by the new vendor. It not only sweetens the deal for employees, but suggests a higher, more rigorous bar for service quality moving forward.
It does. And when you look at all those upgrades, Aramark offered Grubhub, a higher minimum wage, reusable containers, specialized dining concepts, you realize that heightened ambition is just the market raising the bar.
Raising the bar for social, technological, and culinary complexity. The Tulane case really demonstrates that U.S. education clients are actively shopping for innovation. And despite its 40-year history and global scale, Sodexo just couldn't match the required investment and vision in this fiercely competitive bid.
And that is the true localized pain point behind that overall 1.2% growth rate in North America.
So faced with slower projected growth, margin compression, and these high-profile contract losses like Tulane, Sodexo, they can't afford to just maintain the status quo.
No, they can't. And they're actively executing significant internal changes and investments designed to refocus and regain that competitive momentum.
One of the biggest structural moves was simplifying the company's portfolio. In 2024, they strategically spun off their benefits and rewards division into a separate, listed entity called Plexi.
And this strategic shift is critical. It goes beyond just simplifying the business. The Benefits and Rewards division was high growth and high margin. By spinning it off, management forced the market to accurately value the core food and services business.
So that core business, the one struggling with 1.2% growth and margin compression. It can no longer hide its operational challenges behind this high-flying subsidiary.
Exactly. It puts immense pressure on the management team to perform.
And they're installing new leadership to drive this focus agenda. Cherry Delport will succeed Sophie Bell as chief executive, effective November 10th.
Right. And a change in the C-suite often signals a new strategic mandate focused on increased discipline, margin recovery, and aggressive sales growth.
And that new discipline is required to address the margin pressure we detailed earlier. Sodexo's ambition is to improve margins over time by leveraging these key levers: deep procurement savings, supply chain efficiency, and better labor management.
All driven by the technology systems we discussed at the start. Simultaneously, they're working to streamline their corporate and back office functions through their global business services program.
Getting that back office lean and standardized should deliver incremental efficiencies and margin improvement in the coming years. It'll help chip away at that 1% margin erosion caused by inflation.
True, but management acknowledges a fundamental truth. They cannot achieve accelerated organic growth without significant investment. That means spending money now to improve future competitive performance.
They highlighted a clear need for increased investment in OPEX, or operating expenditure. What specific areas are they targeting with this increased spending?
They're investing heavily in the front line, the sales teams, particularly in North America, where the commercial momentum is lagging the most.
Okay.
They also need significant OPEX dedicated to refreshing their brand image and investing in technology, data, and digital initiatives to accelerate that organic growth. They realize their sales pitch has to be more technologically sophisticated to win against competitors like Aramark, as we saw with the Tulane loss.
And that investment extends to capital expenditure, or CapEx. This is the money spent on assets that will deliver returns over a long period. What's the target there?
Their objective for CapEx is set around 2.5% of revenue, and this money is primarily focused on strengthening IS&T information systems and technology and bolstering their development and retention capabilities. They know they need better, more integrated systems and a better sales funnel to win and keep clients.
And beyond internal restructuring and investment, they are also pursuing external growth, specifically through acquisitions in Europe, centered around the development of their group purchasing organization, or GPO.
Right, Integra. And a GPO, or Group Purchasing Organization, is essentially a consortium that aggregates the purchasing power of its members, in this case, Sodexo's clients, to negotiate much lower prices from suppliers.
So Sodexo acts as this powerful middleman, negotiating huge volume discounts on everything from food to cleaning supplies.
Precisely. And Integra is a strategic priority, intended not only to accelerate growth by offering the service to clients, but also to improve Sodexo's own supply chain costs. It's currently in about 10 countries, and they recently reinforced this strategy with the acquisition of Agapo.
So we should expect more acquisitions in that area.
Yes. Management confirmed they have a pipeline for further small and mid-size acquisitions within Integra for the coming period. This really cements the GPO strategy as a major future growth vector for them.
Finally, let's circle back to the persistent operational challenge in the U.S. labor pressure. We saw that explicitly in the Tulane example, where Aramark guaranteed a $15 minimum wage.
Yeah, the labor market in North America remains challenging, and while management is closely monitoring it, and they do acknowledge that political pressures are contributing to higher wage demands, they state that at this stage, the costs are currently manageable and not creating insurmountable operational challenges.
The Tulane example suggests that while they may be managing their existing contracts, they are losing new bids because competitors are offering superior pay and training packages.
That's the tension. So, to summarize their countermoves, they're using technology for efficiency, spinning off non-core assets to focus, investing heavily in sales, brand, and digital tools to win competitive bids, and consolidating purchasing power through European acquisitions.
All while trying to manage tight labor markets and increasingly price-sensitive clients who are demanding modernization. It's a lot to juggle.
It is.
We've reached the end of our deep dive into Sodexo, and the paradox we introduced at the very beginning is, I think, much clearer now.
I think so.
We see this truly global titan, a company operating with incredible scale and highly sophisticated, technologically advanced control systems. That digital control grid keeping 430,000 employees aligned.
But that massive scale and that internal efficiency, it's currently being overshadowed by a hyper-competitive, very complex operating environment, particularly in its largest market, North America.
And if we connect this to the bigger picture, the required response from Sodexo really underscores the fragility of scale in today's service market.
It does. The revised, significantly lower outlook for FY26 landing at the bottom end of their previous growth expectations, and the necessity of high investment in tech, sales, and brand. It all demonstrates that size alone is just not enough to guarantee results.
Continuous evolution, operational agility, and aggressive competitive strategies are required simply to navigate these macro headwinds and prevent existential competitive losses like the one at Tulane.
Sodexo is fighting a two-front war. One front is internal, a battle for efficiency and margin preservation using technology and procurement levers.
And the second front is external, a battle for market share against competitors who are increasingly offering these highly customized, technologically enhanced, and socially conscious dining solutions that just keep raising the bar.
Indeed. And Sodexo struggles in key segments like U.S. education and healthcare, combined with these contract losses that are directly attributed to competitive pressure and client turnover. They raise an important question that extends far beyond just this one company.
This isn't just a Sodexo problem. It might be an industry trend.
That's the final provocative thought for you. Sodexo is one of the world's most disciplined and diversified service contractors. Its decision to dramatically adjust its margin outlook and focus massive capital investment on retention and sales begs the question, is this simply a company-specific adjustment driven by poor execution?
Or could Sodexo's slowdown be a canary in the coal mine, signaling broader industry vulnerabilities for other large service contractors who are operating in the face of persistent economic uncertainty, labor market pressure,